Okay. Thanks for joining the show, everybody. We've got a special guest on today that we think you're really going to like. His name is Brian Murray, and we're really excited to kick things off and ask him some questions about how he got started in real estate. So, Brian, we'd like to start off with how you got started. Maybe you could tell us a little bit about your journey into real estate.
Yeah, absolutely. And first off, thanks for having me on. I'm really excited to be here. I started investing back in 2007. Took a little bit different route to get to my real estate investing. I had worked in the tech sector actually, and began to I stepped off that treadmill and started to teach, but I kind of missed the income, So, real estate, I'd always been interested in real estate. And I said, hey, this might be a way I could supplement my teaching income. And I started looking at properties. I started off like most people looking at really smaller properties, like single family homes and duplexes. And as I dug in and kept doing my research, I realized that as I looked at larger properties, I got more excited and I saw I could get better returns. And, after looking for quite a long time, I began to realize and educate myself, began to realize that maybe there was a way I could pull off a much bigger purchase, and that I could get creative with some of my financing strategies. And long story short, I ended up buying a 50,000 square foot office building to dive right in. And that was my first property. And it was a distressed property on top of that. So I really took on quite a project, but I did manage to turn that around, and that's how I got started. So a little bit different.
Did not start small.
No.
Some people start with properties fewer than 5,000 square feet, and you just said, you know what, I'm going to go with it. So why did you choose to jump right in that regard with something so gargantuan?
I think there were a number of things. One was just that I had figured out how I could creatively finance it and I could make it work. And so the returns were there, and the things that were not working were more obvious than you might think. So I just, you didn't have to be an expert to see all the waste that was going on there, all the neglect. The owner was not local and had owned this property as one of a portfolio of properties in the region, and had already sold off all their other ones and basically had moved on. And this was just languishing. And it just screamed that it needed some basic care. So, the landscaping was terrible. There was trash everywhere. The windows were open no matter how cold it was out or how warm it was out. On the hottest days, the air conditioning would be on full blast, but it would be too cold inside. So the tenants would open up all their windows and let it all out. And on the coldest days, they'd have the heat cranked up too high and all the windows were open, and you could literally see the heat rolling out the windows. And I wasn't a real estate expert at the time, but I knew enough to look at that and go, pretty sure there's a better way to do that. And when I looked down through the expenses, I saw things that could be fixed. I saw property taxes on an assessed value that was about 3 times as high as what I was going to pay for it. I saw labor, and then when I visited the property, I realized that the employee who was there was spending all his time working in a wood shop that he had set up out back. And as I looked down through, even not really having any idea what I was doing, I said, I know enough that these are things that could be corrected. And I knew if I corrected them that I could get the property to cash flow. And I also began to realize that all the scary parts of it, that there were people out there who could explain those to me, and I didn't have to do it alone. I could pick up the phone and call somebody to help me solve almost any problem I might encounter. I did decide to make that leap, and thankfully it worked out.
Yeah, that's awesome, man. There were a couple things in there you mentioned that I think are real interesting. One is the fear aspect. You said something about, well, there were some scary things, but you were able to to understand more about those. And I think that holds a lot of people back from their first bigger deal. And I know it's, it's something that I personally deal with. I'm taking it head on and pushing through my fear right now, but it can be intimidating to think about your first really large deal.
Yeah.
So, it's pretty neat that you kind of work through that. Do you remember what it felt like at the time? Was it intimidating for you?
It was very intimidating. I mean, it was very scary. I think that, like a lot of people with tech backgrounds, I was very comfortable doing research and digging in and figuring things out. And that's a huge asset, I think, that you can bring to bear in another sector. But it's still really scary. And, I'm not even going to pretend that it wasn't, but, you do eventually have to make a decision about whether you're prepared to take that risk. And the savings that I had accumulated through my work in the tech sector was starting to dwindle, and I knew if I didn't do something, take some kind of chance to turn it around, I was gonna run out of money. So I just decided that, hey, let's just take this risk, and I knew I would just pour myself into it and do everything I could to make it a success. And like I said, I'm very, very thankful and grateful that it worked out.
That's fantastic that it all worked out. And I think that for your first deal, there's a lot of marks of success there. You recognize, I'm not going to know everything. How are you supposed to know everything your first deal, right? It sounds like you applied common sense and you profited from using common sense.
Yeah. You know what I've learned over my time working in real estate is that those skills that you build working somewhere else in any kind of business setting can be applied to real estate. And in hindsight, I looked back and I almost felt like not having worked in real estate was an advantage, because as I've spent these years working in real estate, I look at some of the ways things are done and I think they're broken. And so I think going in, the tech company that I worked for, I was the vice president of client services. So to me, customer service was always so important, and I knew that how critical that was, because it was the customers that paid the bills, and those accounts were critical. And what I've found is that's not common to look at tenants in real estate that way. They don't tend to, people don't tend to look at them as customers, and that's what they are. And a focus on a high level of customer service in real estate can really set you apart.
Yeah, that's really good. I like that, and I like thinking about the transferable skills as well, and bringing those over. And that was one of my questions about what is one of the things you think is broken. It sounds like to you it might be that customer service aspect, and how that's not the ultimate focus. People don't quite understand that tenants are your customers that way.
Yeah, and I think it's especially the case with the property management industry, where you have property management companies that aren't actually the owners. And unfortunately, you'll often find sort of an us versus them mentality with the property management companies versus the tenants. And tends to be very adversarial in many instances. And you see a lot of times when an owner is also an operator, they might be a little more connected and really understand how important these customers actually are. But it's less common than you might expect to find great customer service in property management.
I would have never expected that. And that's just interesting to me that you would, like, again, common sense that the person, the tenant is the actual customer, and you should kind of focus on keeping them happy. You keep them happy, you're kind of decreasing the potential for bigger things to happen, such as them not paying or trashing a resident. So that's quite an interesting look, and I'm glad that the transferable skill and that outlook has really shifted your mentality as how you approach real estate. Now, with that, what was the most glaring thing when you were with that building? You were like, "Whoa, I can fix this in this particular way."
I think it was actually probably the most simple things. I think, certainly the labor piece, right? So I made reference to, there was one full-time employee taking care of this property, and frankly, I have no idea what they were doing all day other than working in their wood shop out back and refinishing furniture. But I knew that if I was to cut that position, that I could step in and even working part-time and working around my full-time job, I could get more done than was currently getting done there. And, that opened up, in terms of the fully loaded salary, it was about $45,000 or $50,000 I could cut from the budget that would go straight toward the bottom line. So that was pretty much a no-brainer. And other than that, it was the simple stuff. It was making sure that the property was clean, clearing out the brush that had grown over, and just cleaning up the landscaping. And every morning, the first thing I did when I arrived, because I would show up at this property and I'd work there for at least an hour or two before I went off to my day job. And the first thing I would do is I would walk every inch of that property and pick up every small piece of trash, even cigarette butts, and make sure that it just turned around and it was evident to everyone that, hey, this was under new ownership. It was well kept. The owner cared. And that was enough to make people want to move in. So it really did make a difference, just taking care of those little things.
That's great. Where the attention to detail, I think, is something that often gets overlooked too. When you say you were doing this while you had a full-time job, how did you manage to balance everything? The education, the problem solving, the 9 to 5. I'm just curious in that regard.
Well, as someone who spent some time in the tech sector before working in education, I mean, from my perspective, I would say that a teaching schedule is very forgiving compared to a lot of other positions. It comes with its own set of challenges, but you have a pretty fixed daily schedule. You get a lot of days off, and you've got the summer on top of that. So I was able to put in a few hours in the morning. I'd get up early. I'd come in, like I said, a couple hours before I would have to report to my day job. This was a local property, so I could drive from home, come in, walk the grounds, unlock the doors, turn the lights on, check the bathrooms, and make my rounds and do what needed to get done. Then I'd go off to my teaching job. Oftentimes I would be able to sneak out during a lunch hour, come back to the property because it was in the same city, and then when necessary, also come back at the end of the day. And then in the evening, especially after my kids went to bed or I had time, I could spend, if necessary, a couple hours doing things like working on marketing or leases or anything like that that might need to get done. And I found that was a manageable schedule, that I could do that. I wouldn't want to do it indefinitely, but I did do it for a long time, and continued to grow my portfolio by adding properties, and managed to balance those two for about 7 years before I quit my teaching job.
Wow. Yeah, that's, it's cool to hear the hustle, and all of the effort that you put in, because I don't know if people get to hear that all the time. You sort of see people where they are. A lot of times it's the more successful people that you see or hear from, and you don't realize how hard someone like yourself worked to get there. And so, it's kind of neat to hear that side of things. And I'm kind of feeling that right now myself. Like, I'm working really hard, and I could tell you it is a lot of work to try to get somewhere where you want to be, to get to the next level. So yeah, it's pretty cool.
I think it pays off. I think if you're willing to make that sacrifice, the other really ironic thing is that I started doing real estate to add to my income. And for those first 7 years, the biggest reason that I didn't step away from my teaching was that I just couldn't get myself to pull money out of my real estate, because I took so much pride in it and I wanted to grow that I found that the price was too steep to me to try to pull money out. And so I kept every dime that I brought in, I kept putting it back into improving my properties and buying additional properties. And so that money would grow with time. And so now I look back and realize that sacrifice was definitely well worth it, because I was able to grow a very sizable portfolio And I wouldn't have been able to do that if I had quit my job earlier or I hadn't reinvested money back in.
Can you elaborate on what you just mentioned about the price of the money being too high? I think some of our listeners would benefit from an explanation on that.
Yeah, a lot of people are more familiar with compound interest and just know that, hey, when you invest that money and you gain the returns, and then if you reinvest those returns and they earn money, that it really accelerates, and it's shocking the power of compound interest. And real estate can do the same thing for you. If you're willing to continually take your returns from real estate and invest them back into real estate, then you can achieve compound interest through real estate. And that can be a very, very powerful thing. And if you're willing to do some of the work yourself and keep some of that money that would have gone to a property manager or to investors, then that money can be reinvested back in and you get even more amazing returns. So that's some of the advantage of doing things yourself if you can manage it.
Yeah, that's a cool thought. Now, a lot of our listeners are W-2 or 1099 professionals who have an interest in investing. They don't necessarily want to leave their jobs, though. They like their job, and they work hard at it and long hours even. But at the same time, they understand the benefits of investing in real estate. What advice would you have for people like that to be able to invest in real estate, but still keep their job? Do they have to do what you and I are talking about, or is there a different thing they could try?
So you've got the full spectrum, right? You could do everything yourself, right down to swinging the hammer if you're really that motivated. But you can also outsource that hammer, and you can outsource the property management so that you're doing a lot less and you're just overseeing a property manager. And beyond that, you could even just invest as a passive investor, which would be like a limited partner arrangement for someone else that's bringing investors in which case you literally don't have to do anything other than receive a check in the mail. So anywhere on that spectrum will work. Now, you just have to accept the fact that the more you outsource and the more you give to somebody else, the more it's going to cut your return. However, if you're saying, hey, maybe I'd get a 20% return if I did everything myself, maybe I'd get a 12% return if I'm a limited partner, that 12%, you might be very, very happy with 12%, right? So if you're not interested in getting in that deep and you don't want to work those crazy hours, or you don't even want to manage a property manager, there's plenty of syndicators out there who would love to have you as a limited partner, and you can invest in those deals. Now, you have to be very careful about who you invest with and make sure your money is going to be as safe as it can be. And there's always risk, no matter how much you do yourself, no matter how much somebody else does. There's risk involved in any return, and the higher return, usually the higher the risk. When I jumped in, I drained my retirement account to do it. I had everything on the line, and I couldn't get myself to trust someone else to take responsibility for all of that. So I just wasn't willing to do that. But I fully respect that there's a lot of people who are in different situations, and you got to find the vehicle that works the best for your own given situation.
So one of the things that I started to think about when you were answering that question was whether or not you have investors, equity partners or people who invest capital with you.
So up until now, I've never taken money from any investors. I don't generally do partnerships. I haven't taken money from investors, and there's huge advantages to that, because I can pull money from some properties and use it for other projects. I can make the decision to reinvest money back into a project and not have to pay investors. And that's been great. And my company's grown really fast. Now, at the size I'm at right now, it's become pretty much impossible to maintain the crazy growth rates we've experienced and grow entirely organically. So I'm working right now on pulling together my first syndication deal. And, I probably will do more of those in the future. And so I have a lot of respect for all the syndicators out there that do it that way. That's just another path that a lot of investors take in order to get into those larger properties. And, I think it could be rewarding, from my own perspective to consider the fact that, hey, I've done pretty well for myself at this point. Maybe in addition to allowing me to continue to grow, I can create some wealth for some other people as well. So, I'm looking forward to that, and I always love to try new things and learn and learning all about the syndication process and how that works. It's been fun for me.
That's fantastic. So, stepping back into younger Brian's shoes, if you had the opportunity to invest with somebody as you are learning how to be a syndicator and what makes a good syndicator, for somebody with the 1099 that wants to be a limited partner, what are some things they should look out for from a character perspective if they want to invest with the syndicator?
Yeah, that's a great question. And I don't think there's an easy answer.
Sure.
I really believe that as with any investment, I think you can look at probably you're investing as much or more in that person, that entrepreneur, as you are in the property itself or the market or anything like that. And I actually think it's not all that unlike investing in a tech company, right? I mean, it's an investment, and you're saying, hey, I'm trusting my money with a person. How do I feel about that person, right? Do I feel like that's somebody I can trust, and what goes into that? I think you just got to use your best judgment to say, hey, is this someone that, appears to be a person of integrity? Do they have a track record? And so a great way is I would say, talk to people who've had a positive experience with a syndicator, and just try to find somebody that you're comfortable with. And it's not easy because, frankly, looking out at the landscape, especially in certain markets, a rising tide tends to lift all ships, and it can make everybody look brilliant. And some people were just fortuitous enough to be in the right place at the right time, that you if in a certain market, if no matter what you bought, if you bought 5 years ago, you look like a genius right now. So how's that same investor gonna look when things kind of go through their inevitable cycles? And it's very hard to gauge. So there's no simple answer to that question, but I really think it boils as much down to who you're investing in. So I'd focus a lot on that.
Yeah, so that's interesting. You mentioned a little bit there about people who bought a few years ago are looking good right now. There's a lot of talk out there right now about the spot in the market we're in. We're in the cycle we are. A lot of people feel like we're near the top. And I can tell you, as someone who is breaking into it right now, it's a difficult time to get in. I can't wait to look back on this in a few years and talk about what it was like to get in right now.
Yeah, absolutely.
It's got its own set of challenges right now that you get with this part of the market, right? And they're just different ones than you probably had at a different time in the market. But I am kind of curious what things feel like for you right now in today's environment. Like where do you think we are? How does that feel to you? And what are you doing based on that?
Yeah, so I certainly don't have a crystal ball. It does feel that they're some of the hottest markets in the country. Personally, I wouldn't go near. So the way I feel about it is I'm a little bit old school. I don't ever plan on appreciation coming in. It just I don't plan on my investment panning out strictly because I think cap rates are going to continue to drop or even stay the same. I want to look for properties that are going to cash flow. And, if a property cash flows and you don't put yourself in a position that you have to rely on a refi in the near term, you should be safe if the market doesn't do well. But you need to be really careful with that. So you want to focus on things that are going to cash flow well, and that will help you to ride out any kind of storm. But it's never without risk, and even though cap rates are low, you can still buy at a level where you can and borrow at a level where you can guarantee or nearly guarantee, with some good judgment that, hey, this is a property that's likely to generate positive cash flow for the next 10 years. And if there's a cycle in the meantime, you should be able to ride it out if you structure your debt properly.
Great. So it's all about creating the deal in the most risk mitigated way possible, is what it sounds like.
Yeah, it is. And you have to be, if you're going to be a passive investor, I mean, that's a couple things to look at. How leveraged is the deal, right? I mean, because the other challenge with a syndication is you don't just need to positive cash flow, you need to pay out money for investors, and that eliminates some of your cushion, right? So it becomes more challenging. A deal has to perform at a certain level in order to both sustain a downturn, but also pay investors at the same time. So you're finding in today's marketplace, it's more challenging for somebody who's going to bid on a property or come in and try to buy, for instance, a large multifamily property. If they're a syndicator, they're going to have a little bit more of a challenge making a competitive bid compared to someone who's not syndicating and has a little more flexibility there.
Okay, so because they're syndicating, they have to be safer. They kind of have to approach it differently. Now, speaking of these markets that you say you would avoid, what are some things you're looking for in those markets that scream, okay, Brian, we need to not be in those markets?
I don't think you should be buying if you're. This is my personal standpoint. If you want to get your return on investment, your cap rate needs to be a good gap between your rate of borrowing and your cap rate, right? I mean, as an investor, that's what you're looking for. You're going to take advantage of that spread, right? You're going to borrow money at a certain rate and you're going to get a return that's superior to that rate. And so, I think you want to avoid markets where you're seeing cap rates dip down close to what your borrowing rate is. And that leaves you very little cushion. And, what those people who are making those plays, they're banking on continued rent growth, continued appreciation of property values in those marketplaces. And there's risk associated with that. And there's not a lot of cushion. So, those are the markets that I would avoid. And frankly, I wouldn't have been able to grow the portfolio I've grown if I wasn't able to achieve better returns than that. So you're going to grow very slow, even if you're, even if the market stays steady, your growth rate is going to be quite a bit slower.
Brian, for those people who may not know, when you say a cap rate compared to interest rate, can you expand on that a little bit, just for some of our listeners who may not know exactly what you're talking about when you say that?
Sure. So your cap rate is basically your expected return on an investment in a real estate without considering your debt. So imagine you went in and you paid cash for a property. What's your return on investment going to be for that property? And cap rates fluctuate depending on the overall market and a property's perceived level of risk. So if you have a property that's perceived to be stable, not a lot of risk involved, an investor will tend to accept a lower return on that because of its stability. If you have a property that's perceived to be more of a risk and maybe in a riskier marketplace, or maybe it's unstable in some way, an investor is going to demand a little higher return on their investment, and the cap rates will be higher. So when you have a situation where you're going into a property with a low return on investment, but then to borrow money to put a mortgage on that property, you're paying out an interest rate to the lender that's almost as high as your return on investment from the property itself. That leaves very little cushion for you to actually generate a return for yourself, and if you raise money for your investors. And there's risk associated with that. You want to have a cushion where you've got In addition to being able to cover that debt, you want to have a cushion in case things, don't go well. You have a drop in occupancy or rents drop for some reason. You don't want to have a shortfall of cash.
All right. Makes sense. Thanks for that. I have a quick question. I don't know why this popped in my head, but it may be interesting to some of our listeners. What you think about smaller markets? I know some people like to stay in bigger metros, and some people don't mind staying within a certain driving range of a metro. I'm curious what your thoughts are, what your preferences are on something like the size of a city you look for.
Yeah, so I'm probably a little biased on this because I've had a lot of success in a smaller marketplace. I believe that investors can do very well in secondary and even tertiary markets as you get outside of those major markets, and the biggest reason for that is that your cap rates tend to be higher. The large investors tend to want to be in those major metropolitan areas, and therefore there's more competition for those properties. The prices go up and your returns are lower. As you get into the more rural marketplaces, you have whole groups of buyers who just aren't interested anymore. There's less competition, so you tend to get better returns on those properties. The reason those returns are there is because the investors look at it and say, hey, there might be less underlying value in the land. There might not be as many alternative uses for this property. Maybe the growth rate isn't there, although just because a place is rural doesn't mean you don't have the growth rate. But there's a variety of reasons why you get a lot fewer interested parties in properties that are more rural. But at the end of the day, you're putting your money to work. And if you can get a superior return by buying in a rural marketplace, I'm all for that. I think that it becomes critical that you do your homework and make sure you know your market. So if you go into a small market and you really don't know it at all and you don't really understand the dynamics in that market, you could get in trouble. But if you do your homework and you know what you're doing and you can get an extra 2%, 4% return on your investment, why not? In the long run, if you're going to try to compound interest, and you can run the numbers and see what an extra 2% will do for you over 10 years, and it's going to shock you if you run the numbers.
Yeah. Nice.
Do the math, and the math will tell you what to do.
That's right. That's right.
Now, sorry, go ahead.
Just in the end, if you're making all that extra money, do you really care if your property was in, downtown Orlando or, 30 minutes outside? I mean, I'm not sure you're going to care when you're checking your bank account.
Yeah, I wouldn't.
No doubt.
Kind of a silly thing to really care about.
Yeah.
No, as a syndicator, I know that you are raising capital. And in your experience, what's been working for you to raise the capital? I know that there are very strict SEC rules that you cannot do when it comes to raising capital. So I would love for our listeners to understand some of the ways that you as a syndicator are raising capital.
So that's totally new for me, right? So we haven't closed a syndicated deal. We're putting together our first ones right now. And frankly, I don't plan to raise a lot of capital. Like I plan to partner with somebody who has a network of investors who specializes in raising capital. Over the years, I've had a lot of investors ask me if I accepted investments, and all the way up until now, I've always said no. So I think once I put it out there that there's going to be investment opportunities, I think that I've got maybe some pent up demand. We've just had a fantastic track record with our investing. So frankly, it's not something I've devoted a lot of energy to. So I'm probably not the best person to speak to that.
I mean, you're approaching it effectively, right? There's a lot of self-awareness that I'm getting from our conversation, whether it was knowing the questions that you didn't, or the problems you didn't know how to solve, bringing in the right people, or understanding from a limited partner perspective, or if you're bringing capital to the table, what types of returns you're looking for, how much work you want to do, but also you're self-aware as a newer syndicator. Look, my skill set isn't in the capital, so let me find somebody that has a network of capital.
Yeah, I like that too. And it's just, what you talked about with building a team, and bringing on those team members where their strengths shine in areas that you need that. Yeah, I love that idea because it is a team sport for sure. So I'd love to shift gears, Brian.
Sure.
I want to ask you about this. For those who can't see the video, I'm holding up Brian's book. I have a copy. So Brian's the author of Crushing It in Apartments and Commercial Real Estate. And I read the book. I thought it was a great book. One of the things I thought was cool about it was not only did you really teach someone about different aspects of commercial real estate investing and some fundamentals, what they need to do that, but you also told some stories through there, which I liked. I thought some of your stories about the solar building and some of the different properties were kind of neat. I'm curious what inspired you to write the book. I couldn't imagine writing a book. So what inspired you?
Well, I am a teacher, so I just love to share what I learn with others. And I think what happened is, as I had success in real estate and grew my company and got some acknowledgement for that, there was a lot of interest from people in trying to do what I'd done. And I had a lot of people coming to me asking for advice, asking for mentoring. And in the end, there's just so many hours in the day. And I did take quite a few people on locally that I mentor and continue to do that to this day. But I found myself having to turn an awful lot of people away. But I was so convinced that if I could do this, other people could too. And I had learned so many things along the way, and I had made so many mistakes that I just said, I just wish somebody out there had put something out there that I could have read that shared what they learned. And I could have made so many fewer mistakes along the way. And I just decided I was going to make this commitment to putting everything that I had learned into a book, and figured that even if people only use parts of it, or, it's not meant to be, hey, follow this roadmap exactly, but certainly somebody could, or if nothing else, they could learn from my mistakes. So over the course of 2 years, every moment I could spare, and even some that I couldn't, I put into writing that book. And the whole goal was to just put it out there and hope that it would help other people achieve success in real estate. And it was, I had written it's kind of funny, but I had written a book about 15 years ago when I was working in the tech space. And at the time I did it thinking, I could, and I had a publisher for that and a literary agent and the works. And I thought, hey, I could generate some income writing this book. And it did terrible. I mean, I got a small advance, but when I calculated it out afterward, I made less than minimum wage with all my time that I put into that book. It was a flop. And so I had really, really low expectations this time around. And I called up my literary agent who I'd used the first time and remind him who I was. And, he was like, okay, let me see your proposal. And he sent the proposal around to a whole bunch of publishers, and they all said, no, not interested. So he encouraged me. He's like, this seems like something that people would be interested in. Why don't you just self-publish? So I agreed to do that. And I told my wife, I'm like, I'm going to self-publish. And I calculated it out, and with getting freelancers to help me to do it the right way, I said, it's going to cost me about $15,000 to do this. And I told her, I'm like, the best I could ever hope for, if someday I make enough to just pay myself back what I put in, that's all I'm looking for. Like, I would be so happy. And, cause I just want to be able to have it to share with people and help people out. And that was literally my sole motivation.
Nice.
And it was very freeing too, because I just wrote whatever I wanted, and if I needed to put it aside for a while and work on something else, I did. And then when I felt motivated, I picked it back up, and not worrying about the how it was going to sell was really liberating. and not having a publisher let me write whatever the heck I wanted to. Probably would have cut some of my stories out. But you know, in the end, it just took off, and it just shocked me. I did a few podcasts when it first came out, and I was on Bigger Pockets, and you know, that was helpful. But right out of the gate, pretty much everybody who read it shared it with other people, and the sales just took off. And I think I paid everything back in the first month, and
Nice.
it's been on and off, you know, on and off as a bestseller on Amazon for 2 years. And you know, I've gotten at this point just dozens and dozens of people who've contacted me and you know, shared stories about how it's motivated them. And some of them have already built their own portfolios, and it's changed lives, and it's been extremely rewarding. So it's
awesome.
one of the more satisfying things I've done. And you know, I'm starting to think about possibly putting another one out there. So gonna have to start writing again.
So what's harder, writing a book or investing in real estate?
Oh, you know, it's interesting. I mean, I love to write, but it's for some reason, like it's just really, really difficult for me, but I love to do it. And I find it really rewarding when it's done. So, you know, I think it's a rewarding activity. It's just, it's hard. And I don't know why, but you know, I signed myself up for it, and, but I'm pleased with the results, and I'll keep trying. And, you know, my hope is it'll get easier as, you know, if I do another one, it'll be easier. Probably won't be, but, you know, nothing easy. I think what I've learned through real estate and writing is that it's the things that are the most difficult that are the most rewarding. And so while they're both difficult in their own ways, I'm not sure I can say which one, you know, which one's harder, but they've both been rewarding.
Yeah, that's cool. What I really like is that you have the heart of a teacher, and that comes out in the way you're answering these questions. Kevin and I both feel the same way. I mean, that's one of our favorite things about this podcast is we just love to grow ourselves and other people along with it. And I can tell that, you know, you feel the same way. So it's cool to hear that your book has done that for you. Yeah, that's really neat. And the stories in there are pretty cool. Like, I can't imagine what you felt like with that solar building and not knowing the outcome. I mean, you read the story and you know how it ends, but in the beginning, when you didn't know how that was going to turn out, I can't imagine how that felt. Was that a little scary at the time?
Yeah, I think at this point I realized that almost any real estate project can turn out to be scary, you know, especially the kind that I tend to take on, because I really look for those value add projects, and usually, you know, the opportunity to improve a property significantly inherently means there's usually something pretty wrong with it. And so the worse the problem is, you know, the more drama there can be, and you know, unexpected surprises. And you know, that is something that just comes with the real estate investments. You know, you kind of have to accept up front that things will go wrong, and you got to plan for that. And you know, the more of them you do, you kind of accept that, and it's part of the deal.
Yeah, well, it's kind of cool that I think over time it builds up your confidence, and you realize, you know, I can handle anything that comes at me if I just stay calm and work through it. You know, you work through enough of those tough problems, and it builds your confidence and makes you realize you can handle it.
Yeah, it makes it easier to sleep at night. You know, I think back to the first couple of years, and you know, the type of things that just I thought the world was ending, and it was all over, and oh my God, you know, I'm going to be living in a cardboard box. And you know, you get through them. You always figure out a way, and you know, thankfully I haven't hit that one that's kind of like, you know, put me down. So But yeah, we hit problems every day, and some of them are pretty scary. But the more you deal with them, the more you realize, hey, it's just another day. We'll get through this, and there's always a way forward.
Nice.
And you realize that, hey, what you don't know, you can find somebody that does know the answer, or you can read a book, right? I think that's also a fantastic way to acquire knowledge. You mentioned a mastermind earlier in the call, and what are your perceived benefits of joining a mastermind? Why would you recommend somebody look into something like that?
Well, I joined my first mastermind last year, so I was definitely late to the game. I really wish I had done that sooner. And it just was really eye-opening for me, and it was great. I think no matter what you're interested in, whether it's real estate or anything else, if you can put yourself in an environment where you're surrounded by other people that share that same passion or interest, it's super motivating. And it's also, it's a group of people who can kind of get what you're dealing with and maybe get you and the challenges that come with what you're doing. And, it doesn't even, I was thinking about it. I'm also a runner. And so I always find it motivating when I go to a race. And part of that is you're surrounded by other runners, and you can say, oh, these people get it. They get the training that goes into, showing up for the race. And then you don't feel so weird anymore. You're like, hey, there's other people like me that do this weird thing, whatever it is. And, real estate investing, if you don't make an effort to go out and hang out with other real estate investors, or go to some kind of meetup, or a mastermind, or whatever the case might be, you kind of can feel alone sometimes. And so if you go to a meetup or a mastermind or anything like that, you surround yourself with people who are dealing with the exact same things you're dealing with. They can share their mistakes and you can learn from them. And if it's in your local marketplace, you can compare notes on contractors and attorneys and lenders and all kinds of other stuff. And, if the mastermind I'm in it's a national one. And it's been, I've learned so much. These people are dealing with the problems I'm dealing with on a similar scale or larger scale, and in all different parts of the country. And it's a chance for me to learn and for me to share what I've learned with them as well. And it's been really valuable.
With the mastermind, I think some people who don't have a wealth mindset, a growth mindset, or understand the benefits of that, hear the expense involved, because the ones that I'm familiar with are not cheap at all. And I'm curious what you might say to someone who finds what you said interesting, but they find out how expensive it is and they think, wow, that's a lot of money. I'm just not sure. What might you tell somebody like that?
I think it's a tough call. I'm not gonna sit here and go, it's definitely worth it no matter how much money it is. Right. I think that, once I went to the mastermind and found it as valuable as I did, I came back to where my office is located, which is in a smaller city. And I started a local meetup for free. And I just said, I think I want to help investors on a local level be able to get a similar type of thing just on a smaller scale. And it's been super valuable for them. And I think in most markets, you can find opportunities to meet up with fellow investors and not have to go to that, I know there's ones out there that can be even $50,000, $100,000 a year to join. And if you're not at that stage in your investing, I'm not going to say, drain your retirement account and spend your last $100,000 on a mastermind. So you got to do what makes sense for you. We're at your stage as an investor, and I'm just sensitive to that because I see people dumping $20,000, $30,000 into some training that there's a lot of people out there that are preying on, the hopes and dreams of aspiring real estate investors. And so you got to be careful. I wouldn't join a mastermind unless you have talked to somebody who's in it, that vouches for it and can explain to you why they think it's worth the money that you put into it. Because you're right, it's a big investment, especially if you're just getting started out.
Yeah, that's fantastic. I think that's super advice for people.
Yeah, I'm a big believer in mastermind group, as our listeners know. That's where Adam and I actually met, and what inspired the podcast. And from your perspective, when you were deciding on a mastermind, what were some things that ran through your head? Like, I know you said talking to people, but were there like, wow, this person has the knowledge that I want? Or what was the thought process in deciding this is the mastermind I want to choose?
Well, I had done some research on my own into what was out there, and I actually didn't proactively go out to this one. It was developed by somebody whose podcast I was on, and I had a really good relationship with that person, and felt like it was worth it to give it a try. So I really didn't know what to expect. I hadn't done it before, but I had a little bit of trust with this person who I had some respect for. And I said, you know what, I'm going to go. And there was no commitment. It was he was very comfortable with having me go to one and assess whether or not I felt it was going to be valuable going forward. And, I had a really positive experience, and I decided, hey, this is something I'm going to stick with. And I met some good people. So, I think it could be a good route for people.
Yeah, I agree. So we have a question that we like to ask listeners. It's a little more of a fun question about, and you being a former tech guy, this ought to be interesting. So yeah, what's your favorite piece of technology, or what's a piece of technology that you really, really like right now, maybe?
Off buttons, maybe. No, I love tech. I use so many different tools. I don't necessarily have a favorite one. I mean, there's some really there's a whole bunch of them I use for my real estate investing. But I don't know that I could recommend a specific one. I do think that, especially for guys that love tech, or women that love tech, I think that I do think getting away from the tech can be a challenge, and I love the fact that there's apps and stuff coming out that's meant to help with that and limit that. So one that's new for me that I've been enjoying is I recently subscribed to Headspace. And I've started to meditate, and I didn't think that was something I would ever do, but I'm trying that out. So I think that's pretty cool that stuff like that comes out there, that I know it's a real positive use of technology. So I'll go with that.
Yeah, that's cool.
Yeah, that was an unexpected answer at first. You turn off the off button, but it makes sense. I think we kind of all
agree. Technology. I'm glad those are there.
Yeah, I agree. Otherwise, it'd be on 24/7. Well, Brian, thank you so much for your time today. We've covered a lot of information. Especially, I love the story of how you jumped right in and said, you know what, I'm going to try this and see what happens. And you've grown from there. So thank you so much for sharing your journey with us, the lessons about syndication and the benefits of a mastermind. And we hope our listeners got a lot of information from this conversation.
Yeah, thanks, Kevin. Thanks, Adam. I enjoyed the conversation, and I really appreciate the opportunity to be here.
Yeah, this was awesome. So, Brian, where can people find out more about you?
You could find me on LinkedIn. You could find me on Facebook. My company's website address is washingtonstreetproperties.com. And you could find my book, Crushing It in Apartments and Commercial Real Estate, on Amazon.com. And if any of your listeners read the book and they have any questions, I'm more than glad to answer those if they want to reach out to me.
Awesome. And we'll put that stuff in the show notes. So once again, Brian, thanks a lot. We really enjoyed having you.
Thanks, guys.